You've probably noticed this trend. In the last few years, a new kind of company has started appearing on the Indian markets. Not your usual banks or paint companies, but tech-enabled platform businesses. Think Zomato, Paytm, Nika, and now the Urban Company. The Urban Company is probably the most talked about stock in the last few weeks. It opened around 160, made a high of about 200, and then it fell down to about 140. So, what do you think? Is the Urban Company valued fully? Is it overvalued? Is it undervalued? How do you value this company? That's the challenge with most of these tech enabled platform businesses in India. When you look at their PE ratios, they're either negative, unavailable, or sky high. Why? Because these businesses are still scaling. They're not traditional manufacturing or consumer companies. See, in the US, investors have spent decades learning how to value such companies. Think about Facebook or Meta, Airbnb, Uber. These are all platform businesses that started out unprofitable but built enormous long term value. But in India, our markets are still dominated by old economy names, stable, predictable, but also reaching maturity. Now, as India's GDP expands, growth rates will naturally cool off. And that's when the focus will shift towards these scalable, asset light digital platforms. That's what makes Urban Company so interesting. It sits right at the intersection of India's growing middle class, digital convenience, and the gig economy. And in this video, we will try to decode how to value platform companies like Urban Company using a very simple but powerful framework. So if you're excited to learn, please drop an excited to learn in the comments below and let's get started. Before we begin, please note this is not any kind of financial advice. I am merely sharing my opinions and my understanding based on years of experience in the US markets, and now I'm trying to apply that in the Indian markets. So this is me simply sharing my perspective and my viewpoints with you, and in the process, maybe it will help you get some education and perspective from a global perspective. So let's talk about the Urban Company's business model. Now, the Urban Company, which was formerly known as Urban Clap, it operates a tech-enabled marketplace, connecting customers with verified service professionals for everything from plumbing to cleaning to beauty and appliance repair. What's key here is that the Urban Company doesn't employ these professionals directly. It works as an aggregator, taking commissions on each completed job. Payments, scheduling, quality control, all of this happens on the app. Now, if we talk about the revenue streams, then the first one is that they get commissions from professionals, which is about 85% of the total revenue. Then there is lead generation and subscription fees. The third is product sales, tools and consumables that these professionals need to use. And also they have this RO business called Native. And I believe they are also coming up with home security or home lock systems. And then they have the advertising and partnerships. And now the company has recently organized into four key segments. So one is the India consumer services business, and that excludes InstaHelp. I really don't understand why InstaHelp is not included in that, but that's up to the management. So that's the India consumer services business. If you need plumbing services, cleaning services, or if you need any kind of beauty services, you can just leverage the India consumer services business. The second is their product sales, like I said earlier, the RO business sales under the Native brand, which is their in-house brand. The third is the international business. Again, it's very similar to the consumer business in India, but this operates in the UAE, in Singapore, and also Kingdom of Saudi Arabia, but there's some sort of a joint venture with a local organization there. And the final one is the InstaHelp, which is like the daily housekeeping and cleaning service. Again, I think it should be a part of the India consumer services business, but management wants to keep it separate. I believe they feel like this segment can really grow. And this segment currently is in at least in quarter two has been a bit of a problem for them, and we'll get to that once we get to the numbers. Now let's take a look at their recent September 2025 quarterly results. Revenues overall grew by about 37% to 380 crores. Now that sounds great, right? But here's the twist. The breakdown tells us a very different story. The India consumer services business grew about 24% year over year, but if you look at sequentially, compared to previous quarter, it fell 3%. The native revenues, it jumped about 180%. That's impressive, but still losing about 10 crores. Now they've been losing 10 crores pretty much every single quarter for native. And that suggests that they are possibly selling near the cost price of it. Considering that there's working capital tied up with warehousing these RO, and then there was a fire in one of their warehouses recently, and on top of that there's an ongoing litigation with Kent RO. It's questionable whether this diversification makes sense at all. I mean, you are a platform business. Why go about selling RO? I don't understand that, but it is what it is. And again, here as well, if you look at the drag on the EBITDA margins, which we'll come to in a bit, you'll see why I'm not so big a fan of this particular business. The third segment is the international business. Now, it just grew about 7% in terms of revenues, but more importantly, it turned profitable. It went from about 12.9 crores in loss last year to a small profit this quarter. And that's good, considering that the revenue only jumped by about 7%. Turning profitable means that it is able to generate those good margins in the international business. And the fourth segment is InstaHelp. It's a very small segment as of now. It just generated 1.5 crores in revenues, which is up 500%, but still it's just 1.5 crores. But it posted a massive 43 crore loss. Now, of course, that is because it's a relatively new segment and they are trying to make some investments into it to scale it up. Eventually, they're hoping that this would be a profitable and high growth segment for them. So that's exactly what's happening. It's clearly in an investing mode right now and they're trying to expand aggressively. But the expense growth, if you take a look, we talked about revenues growing at 37%. If you look at the expense growth, that's at 56% year over year. And that's huge. So the operating margins crashed from like -6% last year to -21%. That's a sharp deterioration. Now let's look at their balance sheet because this is where things get a little interesting. You can see that they have about 199 crores in cash and cash equivalent, and then they have about 651 in bank balance. Add to that, they have investments about 863 crores. That brings us to a total liquid assets of about 1713 crores, which is more than 50% of their total balance sheet size, which is about 2800. And then they have no major debt, just about 322 crores of lease and other liabilities. So despite a poor profit and loss statement, the balance sheet looks really strong. And it provides a safety cushion for now. But if you go to the cash flow statement, this is where you see the real story. You start with a loss before tax of 53 crores. Adjust for share-based payment expense, which is 48 crores for this period ended September 30th. That's about a 50% increase from last year. Management decided to reward themselves with 50% higher stock despite having heavy losses. You add additional adjustments, you come to operating profit or loss before working capital changes of about 14 crores, loss of 14 crores here. And then you make adjustments for working capital, and then you get to net cash used in operating activities of negative 17.9 crores. You further deduct the cash used towards property, plant, and equipment and other intangible assets of 16 crores. And that gives you free cash flows of negative 31 crores. Now let's talk about how do we even value a company like this, right? Which is still bleeding cash. Let's take a look at if there's any listed peers in India and globally. Now, from an Indian perspective, there is no listed peer. So let's take a look at the global situation. There's a company in the US. It's listed on NASDAQ. It's called Angi Inc. or Angi Inc. I don't know however they pronounce it. ANGI. That's the ticker. It's the US equivalent of the Urban Company. It has the similar home services model. Now, they have about $1 billion in revenue. The thing is, their revenue has stalled. They have been, about the same kind of revenue over the past 3, 4 years now. But it is a profitable company. They sell at a price to sales of 0.5 times and the PE of 9 times. They have a free cash flow margin of about 6 to 7%. Do bear in mind, the Urban Company has guided that they would try and reach an EBITDA margin of about 9 to 10% in a steady state over a long period of time. That's what their plan is as well, which would mean that their free cash flow margin would kind of be around the similar scale. That's around 10%. But we'll come back to that later. The second comparison we can do is with platform companies such as Fiverr and Upwork. Again, these are companies listed on the US stock exchange. Fiverr has a ticker FVRR, Upwork is UPWK. These are online freelancing marketplaces. They have a very similar business model. They do not provide hardware services. It's more of a digital kind of a service. If someone wants to create something digitally, designers, think copywriters, and that kind of a business model. So it's asset light and it's digital. So free cash flow margins in case of both Fiverr and Upwork are in the mid 20s. Price to sales, even if their free cash flows are so high, price to sales is around 2.5 times. Still much lower than what the Indian New Age stocks command. And then there's an Australian company. Its ticker is ART. The company's name is Airtasker. It's a small Australian company, but has a very identical business model. Think of it as the Australian version of the urban company. This company is growing in the mid-teens, so it has not as high a growth as the Urban Company, but it's still good growth. But more importantly, they have turned free cash flow positive recently, and they are selling at a price to sales of about 2.5, 3 times. Now, of course, you could argue that the Urban Company deserves a small premium because it's growing faster. You tell me, what kind of a price to sales should we apply to it? Let's say it's a price to sales of 5 or 6 times. That's still generous, right? Considering all the other companies that we talked about from a global perspective trade at about 0.5 to 2.5, 3 times. Let's say the Urban Company is an amazing company. It has amazing growth in front of it. And let's give it a generous 6 times sales. Now, that would imply a market cap close to 6,000 crores compared to the current market cap, which is north of 20,000 crores. That is a potential 70% overvaluation. Let's do a bit more in terms of the valuation math, right? Let's try to do it a different way. Let's say, okay, let's not get into the price to sales ratios. Let's do a bit of a DCF or project forward. So let's do that. Let's assume that the Urban Company grows at 30% annual revenue growth for the next 3 years. So we're talking about FY 2028. In that case, considering current revenue, if they grow at about 30% annual growth rate for the next 3 years, their revenues could be close to 2,500 crores by FY 2028. The management has been saying that they want their steady state EBITDA margin to be close to 9 or 10%. Let's say they are able to achieve that in the next 3 years. The management hasn't provided any specific guidance in terms of when they would be able to do that, but let's just assume, right, that free cash flow margins or EBITDA margins improve up to 10%. That would be 250 crores of free cash flows by 2028. Now, give it a generous multiple. Let's say 30 times free cash flows. That would still bring us to a valuation close to 7,500 crores in FY28. Now, you might say, but for a company that's growing in like 20 or 30%, maybe that's too low. Let's give it an optimistic 50 times multiple. Even if you do that, and even after all the assumptions that they will get to 10% free cash flow margins by 2028, applying a 50 times gives you the market cap of 12,500 crores in FY28. That is still a 40% downside from current levels. So let's recap it. Urban Company, it has a strong balance sheet. It has a scalable marketplace model. They do have a good TAM, total addressable market. It's huge. But their unique economics are weak. Their costs are ballooning. And I'm not so sure if I'm happy with their diversification moves, all the hardware business included in there. Right now, for me, it's a wait and watch stock. Of course, traders can play the short term swings, but for a long term investor, let's wait for the operating leverage to kick in. Let's wait for the cash flows to turn positive. And let's wait for the stock based dilution to stabilize. 50% increase in stock-based compensation when your company is going negative. To me, that doesn't make any sense at all. I know the management is maybe ex-Boston Consulting and IITs and IIMs, but what's the point? At the end of the day, the business needs to talk for itself. So until then, I wouldn't touch it, not until the price to sales compresses down to mid-single digits and then growth turns profitable. So what do you think? Do you feel that the urban company is overvalued? Is it undervalued? Is it fairly valued? Let me know in the comment section below and I will read each and every single comment. Also, do let me know which other company you would want me to analyze going forward. If you haven't checked my video on the real truth about Nifty's PE ratio and why the average of 18 times is very misleading, check that out next. It'll completely change how you think index valuations in India work. I'll put a link in the description and over here. Thank you for watching, and I'll see you in the next one.